Are you making this one costly financial mistake? If you have money sitting in a standard bank account right now, just parked in a checking or a basic savings account, if you've ever told yourself, I'll just save up a comfortable cushion first, then I'll learn about investing, then yes, you are almost certainly making that one costly financial mistake. The mistake that quietly steals your future wealth while you're not looking. I'm talking about the error that 90% of people make, the one that systematically drains the value of your hard-earned cash year after year, leaving you running on a treadmill of earning and saving, but never actually getting ahead. The culprit isn't a bad stock pick or a reckless purchase. It's a silent, legal thief that's guaranteed to take a cut of your money every single year. That thief's name is inflation. Think about it. What could $100 buy you 10 years ago at the grocery store or the gas station? And what does that same $100 get you today? The reality is, the price of a gallon of milk, a loaf of bread, or a month of streaming services has crept up, and that erosion is constant. This is inflation, and it historically averages around 3 to 4% per year in the U.S. economy. It means the purchasing power of your cash is dissolving by that percentage annually. Now, here's where the mistake becomes catastrophic. Your standard bank savings account is likely paying you an interest rate of, let's be generous, 0.01% to 0.5%. Do the math. If inflation is at 3.5% and your bank is giving you 0.1%, your money is effectively losing over 3% of its value every year. Your $100,000 isn't growing to $100,100. In real terms, it's shrinking to the buying power of about $96,500. You are paying the bank to hold your money, not the other way around. This loss of real value is the hidden cost of playing it safe. People who make this mistake operate from a place of fear. They believe the stock market is like a casino, or I'll lose everything if I invest. So they choose the option that feels secure, the FDIC-insured bank account. But the truth is, by trying to avoid the perceived risk of the market, you are guaranteeing yourself the very real and certain risk of inflation. You are not protecting your wealth, you are slowly liquidating it. Every dollar you're saving for a down payment, for your child's college fund, for your retirement dream, if it's languishing in a near-zero interest account, it's on a diet and it's starving. You might be working harder, getting raises and depositing more, but your net worth in real terms is struggling to keep pace. You're sacrificing your future financial security for the illusion of present-day safety. So is the solution to throw everything into risky stocks? Of course not. The solution is strategic, informed, and begins with understanding this fundamental flaw. So, if the mistake is letting inflation silently plunder your savings, what's the powerful, counterintuitive solution? It's not about becoming a Wall Street day trader or taking on enormous risk. It's about embracing a fundamental shift from being a saver to becoming an owner. I call this the wealth multiplication principle. While saving is about preserving nominal dollars, investing is about owning assets that have the potential to grow faster than inflation, thereby multiplying your purchasing power over time. Your money isn't just sitting in a digital vault, it's out there in the economy, working for you as hard as you worked for it. Think of it this way. When you keep cash in a bank, you're a lender to the bank for a pitifully low interest rate. When you invest, you become a part owner of companies, real estate, or the broader market itself. You're putting your capital to work in the engine of growth, and historically, that engine has delivered returns that outpace inflation by a significant margin. The core mechanism that makes this principle so breathtakingly effective is compound growth. You've heard of it, but most people tragically underestimate its power. It's not just interest on your money, it's interest on your interest, growth on your growth, rolling downhill like a snowball that gets exponentially larger. Let's make it real. If you invest $500 a month and earn an average annual return of 7%, you won't just have $60,000 in 10 years, you'll have over $86,000. In 20 years, not $120,000, but $260,000. In 30 years, it blossoms to over $612,000. Notice the magic. The majority of that wealth isn't from the $180,000 you put in. It's the $432,000 that your money earned for you through compounding. This is the mathematical superpower that the wealthiest people on the planet have used for generations. But here's the critical catch. To harness it, you must start early and stay consistent. The cost of waiting isn't just the money you don't put in, it's the catastrophic loss of those compounded returns. Now, I can hear the objection, but the market crashes. What if I lose it all? This fear is what keeps people paralyzed. The key is to reframe risk. Yes, the market has short-term volatility, it fluctuates, but the far greater guaranteed risk is the purchasing power erosion of cash. The wealth multiplication principle isn't about timing the market or picking hot stocks. It's about time in the market. It's about low-cost, broad-based index funds that own hundreds of companies. It's about tax-advantaged accounts. It's about systematic, automated contributions. You are not betting on a single company. You are betting on the relentless, innovative capacity of the American and global economy over decades. By not participating, you are betting against that historical progress. The path forward isn't reckless speculation, it's intelligent, disciplined ownership. Ready to see exactly how to implement this principle, starting with as little as the price of a weekly coffee run? The blueprint for escaping the costly mistake and activating the wealth multiplication principle is simpler than you think. It doesn't require a finance degree or hours of weekly research. It demands one thing above all, a decision to prioritize paying your future self first. This final section is your action plan. Your journey begins with 3 foundational pillars. First, automation is your ultimate weapon against hesitation. You must make your wealth-building process mindless and mandatory. 1. Open a dedicated investment account. If your employer offers a 401k with a match, contribute at least enough to get the full match. If you don't, open a Roth IRA or a standard brokerage account. This takes 15 minutes online. 2. Set up automatic transfers. The day after your paycheck hits, schedule an automatic transfer. Start with an amount that feels almost invisible. 3. Automate the investment itself. Within your account, set your contributions to purchase a low-cost, broad market index fund. This single step makes you a diversified owner of hundreds of top companies. Second, diversification is your shield. It's how you own the growth without betting your fate on one stock. Your core holding provides instant diversification. Forget picking winners, own the entire field. Finally, and most critically, behavioral discipline is the engine. This is the hardest part because it's psychological. You must commit to ignoring the daily financial news and the volatile headlines. When the market drops, see it not as a loss, but as the entire market going on sale. Your automated purchases will simply buy more shares. Your only job is to not interrupt the compounding. Do not sell in panic. Do not try to time the market. Do not chase the latest hot investment. The history of markets is a long-term chart of upward progress. Your steady hand is what allows the mathematics of compounding to perform its miracle. The costly financial mistake was inaction disguised as caution. The correction is intelligent, automated action. The wealth you build won't come from a wild gamble, but from the patient, relentless application of this simple system. You are not just saving scraps, you are building capital. You are not just hoping for security, you are engineering it. Close this video, open a new browser tab, and start that account setup. The single most important financial variable you control is time. The best day to start was years ago. The second best day is today. Your future self, the one living with financial freedom and choices, is waiting to thank you. Go make that first move now.